Okay, so straight up, Ben, whoever's teaching you this stuff, and I don't know how long you've been doing this or how long you've been teaching this, but that is so not right. I don't even know where to begin. Before you jump in the comments and are like, you might be thinking about a different insurance policy, I saw that you're a fan of Mass Mutual, Guardian, Northwestern Mutual, New York Life, like all phenomenally great companies. None of them would endorse what you're saying. And in fact, if they saw that you had a video like this, they wouldn't want you representing their company. All right, guys, I got another reaction. I'm going to be reacting to how to become your own banker in 2025 and pay zero taxes legally. Sometimes I feel like I'm defending a lot of life insurance and infinite banking from people that are taking shots. But in this video, I'm going to be reacting to someone who's making some very bold claims, and we're going to see my thoughts on it. I think one of the reasons why our industry can get a bad rap is people can say whatever they want. I guess it's America. You can say whatever you want on TikTok and YouTube. But sometimes it doesn't help, some of the clarity and it doesn't necessarily help our industry when there's claims that may or may not be true. And so I'm going to be watching this. This is a guy by the name of Ben who made this video. And Ben, if you're watching this video or you ever want to come on and talk more about what you're up to and some of these claims that you're making, you're welcome anytime. Without further ado, let's dive in.
How to become your own bank. Some people call it infinite banking, but I have to warn you, this is going to piss off every financial advisor that watches this because I am going to walk over everything that you guys do, and I'm going to prove that what you guys do doesn't work and is inferior and how much you do not know about finance.
So immediately when I watched this video for the first time, I'm like, man, like that's one way to start a video. Like, how to Win Friends and Influence People may be a book that Ben wants to invest in, but I mean, he's to his credit, he keeps the same energy in the comments. People kind of comment some things, and he just goes right at it. And everyone has different styles. I will also say this gives me a little bit of Ty Lopez energy, like making bold statements. You're in your garage with your cars in the background, and so buckle up, because this is one of many statements that are being made.
Money. So what's up, guys? This is Ben Oberg. Your not financial advice for today is how to become your own bank, or infinite banking, some people call it that. And we're not going to use these inferior index universal life policies or these low-grade financial products that advisors sell you. We're going to use what very few people know about and what is institutional grade, and I'm going to tell you how you can get access to it all in this video. And by the way, I'm not an advisor. I don't get paid to teach this shit to you. I just want to expose you to the real truth. And I'm actually going to show you advisors in a little bit arguing with me, saying that what I do doesn't actually exist. It does. I've been making a lot of money with it, and I'm going to tell you all of the steps that you can follow to do it, and the 4 specific steps that I use to become my own bank, lend capital myself, get 2 returns simultaneously, go into hard assets that cash flow, repeat the process, pay low taxes, and keep doing it over and over and over.
All right, guys, so I'll just first of all say that this sounds really attractive. I mean, there is a reason why we can say whatever we want on TikTok and YouTube and all, and like I'm ready. Like if everything that he's saying is true, like I'm leaning in. I want to do everything that this person says, and that's why it's important to do due diligence, because usually, and this is not a shot at Ben right now, it's just something I've learned in my life at working at BetterWealth and helping people, is just because someone's confident about something doesn't mean it's truthful. And sometimes the more confident someone is at anything, the more due diligence we should do. And so that's just one of the things that I felt like I needed to share, because sometimes I purposely try to play more middle ground because I see how big of a deal your finances is, and I want to be very careful to not just like there's one size fits all. I've interviewed some people in the past that are pro, let's say, index universal life or other things, and they can be really, really confident in something, and it might sound like it's more credible because of their confidence, but time is the ultimate equalizer.
Welcome to my channel. If you're brand new, if that wasn't subscription worthy, I don't know what is. Make sure to subscribe. We're dropping bombs about teaching you guys how to become your own bank, escape the modern financial system, and build wealth like an institutional grade investor. And I don't gatekeep. I tell you exactly what I'm doing, and I show you that we're doing it. First of all, what is infinite banking? It's this concept where you're basically lending capital to yourself with a tool that you acquire so that you can bank against your own assets and repeat the process. If that sounds confusing.
Okay, I'll just give him this. That's a decently good definition of infinite banking. It's infinite banking, I would say, is storing capital in a place that is going to grow for you long term and that you can use or borrow against to acquire other assets. And, if you're doing this based on Nelson Nash's book, Becoming Your Own Banker, you're using a dividend paying whole life insurance as that foundation. So I think the definition itself is good.
I will explain in just a minute here. First of all, we got to debunk what the financial advice is that you have been told. A lot of advisors sell what's called an IUL, or an index universal life policy, so that you can infinitely bank. There's a couple problems with this. One, IULs have a hidden insurance cost that you don't get to know what it is. So when you're investing in an IUL, which is basically something you could think of like a savings account, but has an insurance component attached to it that you must spend money on, okay? The problem is that insurance cost is hidden to you. The second problem is that IULs tend to only get 4 to 6% in annual returns, which is pretty low. The third problem with IULs to bank infinitely is that you have to borrow directly from them, and it stops the growth of your cash in there. I don't do that. I let my cash keep growing and I borrow against it. So we're going to break this down.
Okay, so I'm not the biggest fan of IULs. You should just know that first and foremost, especially not for infinite banking. So that's the disclaimer, but they're not hidden cost. And you could make the argument that they're way more transparent than even whole life. They show you exactly what the costs are. What maybe he should have said is that there's an increasing cost. Maybe what he should have said is, if not set up and used properly, there can be a greater corridor of insurance, and it can be very expensive, and there can be a greater chance of these things blowing up. But I don't think the whole not being transparent with the cost is the right move there. He talked about IULs getting a low rate of return of 4 to 6%. I think he might be like the only people out there that are using that talking point to say IUL. He's then going to go on and talk about whole life and how it's better than IULs. And I've never heard, I shouldn't say never. That's a really strong word. It's rare for me to hear that people are making the argument that whole life will trounce IULs, and IULs have bad rate of return. So I would not use that I would just not use that argument at all, because I think when whole life is set up and used properly, it's getting anywhere from 4 to 6. 6 might be on the high end, 4 maybe on the high end, depending on where you are. And so that's a talking point that I think could bite you in the butt if you, that's all I'll say about that. And then the third aspect is borrowing from yourself and all. Like I don't know if that's also a great talking point. I do get the whole wash loans, but I think there's different borrowing strategies, and there are people out there. I've had them on my show. I may not agree with them, but their whole strategy is built around borrowing arbitrage on IUL. And so they would straight up 100% disagree with this guy. I'm not saying that their right is wrong. I think that there could be some problems with that, but you could make the argument that all three of his points are not accurate, and an IUL is a better product if you're using his talking points. Again, not saying that IUL is what you should use. I use personally whole life insurance for my infinite banking type of strategy. Majority of our clients come to us for whole life insurance, but I want to call balls and strikes and how I see them, and that's my take on that.
Next thing that you need to know is that how to do infinite banking effectively is with what is called an institutional grade, high early cash value, dividend paying whole life policy, or for short, a HEC-V life policy. You do not want to use Primerica or Prime America, whatever it's called, or an inferior grade company. You want to work with a company that has an A+ grade credit ranking, in other words, higher or as high as the United States government or the US Treasury. Now, the next thing that you must know.
Okay. Feel like he's saying a lot of words. Don't necessarily disagree. You want he talks about a HEC-V product, which is actually a product that MassMutual calls, like they call one of their ways of designing a high early cash value product. It's a good policy. There's different ways you could design. You could use their product. You could use other things. That won't be this video. So I don't necessarily disagree. I think Prime America is like, hey, whoa, why, shots fired. Why are you just coming at us? I don't necessarily disagree with what he's saying, but you would definitely want to use mutual company. You want to make sure that they've been around for a while, good ratings. Those are all things that you want to check, and then you want to make sure that the contract is set up. Lots of flexibility, optimal. Those are all the things that I would say as relates to making sure that you're working with the right company. Probably only a few companies out there, probably less than 10 companies out there that would check those boxes.
Is that this concept and these companies are older than Bank of America, Wells Fargo, and Chase. And the real truth is that you should be making 9 to 11, sometimes 12% per year on your money insured before you.
Okay, I'm going to give him the benefit of the doubt, but yeah, I'm going to give him the benefit of the doubt. Ben, if you're watching this and you want to part 2 on my channel talking through these claims, let me know. But I think you do break down what you mean here. And so that's a strong statement, 9 to 12% rate of return, like insured rate of return.
Anything else. Let's simplify it. Step 1 is you want to get a Heck V life policy. I'm going to tell you who I use, what I do, how I work with it, how you can get access to that later in this video. But let's just explain some math here. You can get a high yield savings account growing at 4, 5, 6%. An average savings account grows at less than 0.5%. What I get is 2 things. I have what's called a guaranteed return, which is 2 to 4% minus 4%. You got to go through an underwriting process and see what you get. But let's just use my example. I get 4%. And then I have what's called a non-guaranteed dividend. This dividend comes to me tax-free. The company I use has been paying a dividend no less than 6% for the past 50 years. So I've got 4% here, and then I have a 6% dividend over here. Combined, what is that? It's 10%. Now this year, my dividend is up to 6.4%. So I'm actually making 10.4% on my money. I don't buy tons of insurance. My insurance cost is literally $37 per month. And every single dime past that I put into this policy is in cash value. You have 4% growth. You have 6% growth. Again, mine's 6.4. I'm making 10.4%. I set this policy up so all of that growth, and when the dividend is paid back to me, it goes back into the cash value. So let's say I just start with.
Okay, so straight up, Ben, whoever's teaching you this stuff, and I don't know how long you've been doing this or how long you've been teaching this, but that is so not right. I don't even know where to begin. And again, the reason I'm making you this video are there are people making these videos on TikTok and YouTube, and we wonder why our industry gets a bad rap, and we wonder why people use the word scam. I'm not calling that you're scamming people. I'm just saying that you're wrong and you're not understanding how this works. And so the guaranteed rate of return and the dividend is not something that you can just add 1 + 1 = 2. Like that's not how it works. The guaranteed and then the dividend, and it could be confusing. I get this. This is where our industry could get a lot better. But you could say that you get a gross return if you want. You could say you get a gross return in your case of over 6%. You could say that. It'd still be misleading because the gross return is not even what you get. What I like to do is show people exactly what they're getting with running what's called an internal rate of return. This is when you get your guaranteed rate plus your dividend, which is not something added on. It's the additional, like above the guaranteed rate of return. It's what the company's actually declaring that they're paying the policyholders. But then what they do is they take out cost of running the business, cost of mortality, and then they pay you the difference. And over a long period of time, you're getting an internal rate of return of anywhere from 3 to 5% long term, like 3 to 5%, the same percentages that you said was terrible. So I just letting you know, like it's feeling like it could be a little bit hypocritical. I'm still a big fan of the strategy, but cash on cash arbitrage is not the way, is not the reason why this strategy is the way to go about it. And if someone's telling you this, because I'm giving you the benefit of the doubt that you're not actually writing these, that you're referring to somebody, and they're telling you this, I don't know how to say this in a nice way, but like you should not be working with them. You should not be sending your clients to them. If you're getting a life insurance policy and this is what you're being told, and then you see the truth, like you can see why this stuff gets a bad rap, and that's straight up false. And before you jump in the comments and are like, you might be thinking about a different insurance policy, I saw that you're a fan of Mass Mutual, Guardian, Northwestern Mutual, New York Life, like all phenomenally great companies. None of them would endorse what you're saying. And in fact, if they saw that you had a video like this, they wouldn't want you representing their company because there could be lots of problems with that. So I'll get off my high horse, but could not believe seeing this. So I just want to set the record straight that I could not agree. I very much disagree with those statements.
$1,000 of cash value. I'm going to keep this in layman's terms, and I'm making 10%. That means I'm going to make $1,000 in the first year. Now I've got $11,000 of cash value that's growing for me, and then that's going to be $11,100, and then it's going to be $12,100 the next year, and that's going to continue growing and compounding, like Einstein said, compound interest.
And the other thing that we got to be careful about is internal rate of return is over a long period of time. In the first couple of years in funding life insurance, you're not even getting all the money that you put in. And again, it might sound like I'm like anti-insurance. I'm not. I'm a big fan of insurance, but I don't like the idea of making insurance being this like quick rich, like you're going to make 10%, you put in 10,000, now you're making 11,000, blah, blah. Like that's not how it works. And then it's like a cold plunge when people see the actual illustrations, and it shouldn't be that way, but it's that way because of expectations. And then there's people that might come to our company and stuff, and they're like, "Hey, I heard about this," and then they're like, "No, I want the sexy type of policy that so and so talked about." It's like, well, that doesn't work that way, and so people will go where they want to go. But I'm just letting you know that not how it works.
Okay, and I'm going to keep stacking that up. That keeps growing at 10% plus for me. And then I get a line of credit against it. So step one, you get this policy. Step two, you get a line of credit against it. This is where IULs become inferior. You have an IUL growing at 6%, and then what you end up getting is a policy loan, which stops the growth of this. You borrow against it, and then you lose the leverage. So what I do is I keep this growing, and I get a line of credit against it at 4 to 6%, okay? This is growing at 10.4%. I'm borrowing at 4, 5, 6%. So I'm already making money. The third step.
Yeah, I don't. That's not true. Anyone that's teaching that you're getting arbitrage using infinite banking is not being above board, in my opinion, across the board. The only thing you cared about was cash on cash arbitrage, infinite banking with IUL or whole life insurance long term is not a great strategy. Some of the IUL people will disagree with me, and some of the whole life people may disagree with me. It should not be. Even Nelson Nash would not. I don't think any time in his book he made big claims about arbitrage. There may be times where that potentially could happen, but if all you cared about is cash and cash arbitrage, you're not understanding the strategy, and you're discounting all the other benefits of life insurance. The life insurance is still very, very powerful to have at the foundation. You should still save, protect your family, and use that capital. But the cash on cash arbitrage of what you're earning versus using, it does not work that way. And in most cases, will never necessarily make sense on paper. And if you didn't value the insurance and all the other benefits you get with having insurance at the foundation of your life, you shouldn't do that strategy.
Go into hard asset, that cash flow, allow me to get all my money out and repeat the process so I am generating an infinite return. And I'm going to dive deeper to that in a second, but that is where the term infinite banking or becoming your own bank comes into play. But let me know in the comments real quick, have you ever done infinite banking? Do you own an insurance policy? If so, what type? I am happy to argue in the comments because I can base all of this on literal fact. And as a matter of fact, the reason why so many advisors argue with me about this, and bear in mind, guys, I own a marketing company that works with hundreds of advisors. None of them do this. None of them know about it. I have met one of 30 individuals in the entire United States that is actually allowed to provide these types of institutional grade products to not institutions, to not banks, but to individuals just like you and me every single day. And I work directly with them. And I'll talk a little bit more about that in a second here.
It's attractive. It draws people in. Even myself, you're like, man, like I'm really curious about this. Like one person in the entire United, and I'm just saying it's yeah, that's all I'll say. I got nothing nice to say, so I'm just gonna hit play.
Step one, you got to get that policy. Step two, you get that line of credit. We help you just get both simultaneously so you don't have to go about it and do it yourself. Then the third thing is you need to go into assets, that cash flow, so you can use that cash flow to pay the line of credit back. So let's just make a round even number, for example. You have $10,000 of cash value. You get a $10,000 line of credit, okay? And your line of credit is typically going to be 90 to 100% LTV, loan to value. So if you've got $10,000 of cash value here, you can get a $9,000 to $10,000 line of credit over.
I appreciate the trick. That's accurate.
Here. And every year that this goes up, what I want you to do, and again, this is my not financial advice, is you level up the line of credit. This is $11,000 line of credit. This is $12,000 line of credit. And that's going to increase your leverage. When inflation is 2, 3, 4, or 7, 8%, like it's historically been in the last couple of years, and this is growing at 10, 11%, and you're borrowing at 4, you're hedging inflation and still making money, right? And again, these are fully insured beyond the FDIC limit of $250,000. These big insurance carriers have to keep as a balance equivalent to the cash value or death benefit. So if they ever went insolvent or just decided, hey, we're not going to be an insurance carrier anymore, we're going to open a McDonald's franchise or become a car dealership or something, they would have to pay that out to you. So it's better than FDIC insured, all right? It is literally what the banks use. That's what I do here, okay? So
I'll say I don't disagree with that. I think FDIC insurance could be considered a joke if there's no reserve, but I think that we've seen banks go down and people have got their money back. And insurance is regulated at the state level. Every state has some type of protection, and then insurance are insanely regulated. And so if you're working with a proper, like a legit insurance company that has good ratings and all, like, you should have no problem at all sleeping at night about the safety of your money. Lots of things are gonna hit the dust before insurance goes under.
Now we need to go into assets that cash flow. I prefer real estate and I prefer oil. I'm not talking about oil stocks. I'm not talking about real estate stocks or ETFs or anything like that. I am talking about the hard asset itself. But if you're like me, I want to do things with my life. So I don't want to actively manage real estate. So I go into a couple really reliable funds that I'm actually partnered with. And then I go into oil and energy deals where I'm working with a landman like that show, an operator out of Oklahoma or Texas, for example, and I'm given capital and they're spitting out cash flow for me as they sell barrels of oil, as they sell natural gas, and as that product gets refined. So I get cash flow every single month, and then they take all those oil wells that they own interest in, and after 3 to 5 years, they sell those oil wells, and that's a big payday. So I use the cash flow of that real estate or that oil to pay the line of credit back, and then anything above that I keep. That's where the infinite return comes in, and I pocket that. And I can do that with multifamily, I can do that with single family, I can do that with oil and energy wells. So that's your third step. The fourth step is to repeat.
Okay, so I don't disagree with his statements that he's making at all. Like, I think my good friend Justin Donald does this with his mastermind. There's a lot of people I know that save money into life insurance. They lend against that, invest in alternative investments, and then it's like that cycle. Totally legit is a way to build wealth. Here's what I'll say though, is you got to be careful. You have to factor in risk. And I hate to say it, Ben, but when you get when you over exaggerate by like a lot, like heavy over exaggerate on the life insurance side, it makes me skeptical of your other things. It's easy to say real estate because the tax benefits, because it appreciates, because you get cash flow, or oil. Why oil? Oil's, there's always going to be a demand for it. You have some amazing tax benefits to oil, cash flow, like all those things are great. I also know people that have lost money in real estate. I've also known people that have lost money in oil. So it doesn't just make, like, I'm just letting you know, like, it's legit. It's a great system. And you got to be really, really cautious when you're entering into things. Do your due diligence. And I'll just say, would I trust someone who's like mainly a marketer? I don't know. You just got to be really, like, almost like, be really grateful that they're making aware, but don't just assume that their thing is the right thing. And I'm saying this with zero context of what they're saying on the back end. So I'm just letting you, like, this is why some people love or hate when I react. I'm just giving you my honest feedback on, like, going through the video. This is the second time I'm watching this. But I'm just like sharing my thoughts, and I've seen lots of people do really well, and I've seen lots of people do really poorly, and a lot of times it comes down to the due diligence or lack of due diligence that someone does.
But there's a nuance to this repetition. Understand that I just said real estate and oil. Now, why would that be? Let me know in the comments if you understand. Why would I specifically go into real estate or oil? I'm curious. Put this on pause, take time to comment, and then go ahead and continue playing, and I will answer that. But I want to know right now what you think. Why do I go into real estate or oil? So the answer why I go into real estate or oil with infinite banking is because real estate and oil, from an IRS tax perspective, allow me to have a lot of write-off. Oil I invest in because the capital that you invest has what's called an intangible drilling cost attached to it. It allows me to write off as high as 80% of the investment capital. So I'm already winning there. Then there's what's called tangible drilling costs. This pertains to the cash flow. Over the next 7 years as I cash flow, tangible drilling costs can be depreciated over 7 years. So I'm able to take depreciation every single year. In other words, lower my taxable income, lower my tax basis on all the cash flow that I'm getting. And the third thing with oil is what's called a depletion allowance, which right off the bat, for every dollar in cash flow that oil well produces me, I'm only having a tax basis of 85 cents on the dollar. Then I get the tangible drilling costs, which are depreciation against that. I pay very little taxes. Now I can go on because there's a lot of other stuff like 1031s in oil, but let's hop over to real estate. Much like oil, real estate offers me depreciation. It offers me passive income tax bracket. It offers me a lot of tax incentives. And much like oil, I'm able to use that cash flow to pay my line of credit back as quickly as possible and repeat the process. And the reason I love doing this, another reason, is because I don't have to wait to like sell the oil deal or sell the real estate to repeat the process, because the cash flow is coming in at such a rampant pace that I'm able to quickly pay that line of credit back and go get another oil deal, go get another real estate deal before I've even sold or capitalized completely on the initial one. Now, if you guys want to learn more about this, this is what the Capitalist Network is about. I've included a link in the description. I connect you with all of my oil operators, all my real estate guys, all my fund managers, my precious metals dealers, my exotic car people. I get you in front of all of them so you can learn how to do all of this yourself. You understand economics. You're able to actually partner with us, go into our deals, and get firsthand access to the type of deals that are not publicly open to the market or available. We expose you to all of that inside the Capitalist Network. I've included a link in the description. Again, if you're brand new, make sure to subscribe because I'm dropping videos like this.
All right, guys, there you have it. Go subscribe. I'll say, Ben, if you're watching this video and you want to come on, or if you're Ben's insurance guy and you're watching this video and want to come on, would be more than happy to chat with you. Maybe I'm overreacting. Maybe I'm missing something. I very much like when people are making videos, bringing people awareness. I'm a big fan of freedom of speech. On my show, I bring on people that disagree all the time, so I like having different conversations. But I will say this, that life insurance is an amazing asset that, number one, protects you and your family. I don't think Ben mentioned this once. Like, it's first and foremost a protection asset that's extremely powerful. And then it allows you to have a lot of benefits that gets better over time. Power of compounding. Lots of benefits that get better over time. You can use your capital throughout your life to invest in some of the same things that he's talking about. Just be careful to however you use your money doesn't guarantee that you're going to be rich. It's how you use your money that matters. And you're still getting all the benefits of your insurance and that protection. And then it gives you lots of future options in the future. So like, I'm a big fan of life insurance. You might watch this video and be like, oh, Caleb's, now in the Dave Ramsey camp. No, but the reason why Dave Ramsey and Susie Orme and Ramit and all of them have like endless content is because of videos like this, because people go in and, I'm not going to speak this over anyone, but it wouldn't shock me at all of people that watch these type of videos, get life insurance, don't really look at the contract, boom. So number one, they're shocked there. Then they go borrow against their policy, put their money in deals that may or may not be vetted properly, and then boom, I've seen this. It's not just like this is theory. Like, I've seen people do this, and that's why I feel a moral obligation to share this and create this perspective, and also say like, life insurance is incredible, but it doesn't need to be overpitched. So that's all I got. Keep sending me videos if you want me to react. I appreciate you all. And if there's anything that we can do, if you have a policy that you want us to take a look at, make sure that it's set up properly. We'll have a policy review down below. If you're someone that's like, I'm interested in seeing what a policy would look like for me, that's not, set up properly, and whatever that means, we have a link down below there. And subscribe and follow for more content.